4th of March 2022. Haven't been doing videos this week, been sick, still sick. Anyway, I'm going to try and do a few videos now, one on puts and one overall on the market and what I'm doing. Okay, so this one's going to be about puts. I haven't been buying puts. Now, I want to address why. Well, quite simply, it's not really sort of part of my business plan. I've been sort of more focused on finding stage 2 stocks, which are stocks that are broken out of a base, going into an uptrend and buying calls on those. So, yeah, so I haven't been focused making money on the downside. However, just been thinking, and I've noted this in a few previous videos, I've generally done not a bad job at sidestepping carnage when it comes through. I was getting cautious in December. So should I be thinking then, well, should I be looking to make money on the downside by buying puts if I think things are getting a bit overheated? So because I broke the market down into 4 stages, double green, amber and red. So when I sort of starting to note that a lot of that sort of it's all too easy to sort of make money, everyone's sort of wildly bullish, that's the time to start getting cautious. Do I need to take that one step further? Is it time to start thinking about how to make money on the downside when the party ends? So there's a few reasons I haven't typically bought puts. The first one is I like the idea with calls, there's almost unlimited upside. With puts, there's only so much money you can make as the stock goes down. So that is basically the difference between zero and the strike price. So stocks can't go any further, well, apart from oil a few years ago, further than zero. So there's only so much money you can make on a put. I just don't think my eye is trained to look at charts that are setting up well for the short side. Like I said, I've just been focusing on looking for stocks going into stage 2. And therefore I'll probably get a little bit sort of more complacent during sell-offs. Looking for signs of a bottom, looking for stocks that are swinging back up in that stage 2. So I'm going to give you an example, and this was a trade I didn't do, but someone on Twitter did. So this is the RSX, Russian Stock Exchange. You can see here why anyone would be long this market is beyond me, because it's sort of the best it can usually do is just sort of meander upwards and then have this sort of violent sells. You can see here it meandered up, rolled over, the moving averages had rolled over, the 200-day had rolled over, started selling off, had a pull back to the 50. And this is when the whole Ukraine war situation was starting to get more serious. And yeah, someone bought some puts here. So let's go through that. So I think the actual entry is fantastic. You can see sort of pushing pretty clearly into a sort of stage 4 sort of move here. So someone paid $3.60 for August 2022 puts that had a $25 strike. Now, if I work that backwards, that tells me the implied volatility at the time of the trade was about 51%. Now, the problem I have when I look at those sorts of numbers is paying $3.60 for a put without knowing that the market's just going to completely collapse. Doesn't normally look that good to me. So, because the most you can make on this trade, and that's assuming the RSX, which is the entire stock market, goes to zero, which potentially in hindsight wasn't actually that far off the case, was $25. So $3.60 to $25 is the maximum payout. Now, it turns out what has happened is obviously sanctions, etc., have hit Russia pretty hard. The RSX has fallen apart, and these puts are now worth $20. So someone's made really good money out of that. Now I just asked myself the question: is that a trade I should have done? Yeah, possibly. Still like the size of those the price of those puts probably freaks me out a little bit. One thing I have been kind of considering though is typically when you get a sell-off, the sell-off comes very, very rapidly. Not necessarily this rapidly, but a bunch of tech stocks have fallen apart pretty rapidly, as opposed to when they're going up, the upwards of the slope that tend to be a bit more gentle. So do I therefore buy shorter dated puts to get those put premiums a bit lower? Yeah, that's the question I'm just working through at the moment. A few other examples. XPEV. So this is, I talked about this in a previous video. I had owned calls on this. I said I was going to sell them around about here. Reason being, in a big sloppy base, nothing to get excited about there. It's not stage 2, it's stage 1, maybe even stage 3 for all I really know. I know it's just not going up. Anyway, and also it was sort of price was wedging up to the 200-day moving average here. So again, also in the context of the market, things not looking good for tech stuff. Let's get out. I'm actually quite happy that I made that decision, but then should I have taken it one step further and say, right, well, if this is like if I think this is a bear wedge here, then therefore should I have been just turning that trade completely the other way around, sold the calls and then bought puts? Yeah, quite possibly. That would have been really quite a fast money maker, that one. Similar with ARK. This huge run, stage 3 sort of distribution through here. Look at the volume. Can't make up its mind after a huge run. Clearly stage 3, clearly moved into stage 4. First pullback entry for the short side here, in hindsight. Should have been buying puts here. Putting aside, so not knowing what the implied volatility was, but in terms of an entry point, this was this was it. Lots of money to be made here. So yeah, I think what I'm going to do is try and incorporate, at least on a very small scale, buying puts in against stocks that are in a weak sector. The stock itself is in a downtrend, but giving a pullback buy, and also particularly on stocks that are in the weak sectors, but a stock that's going into earnings. Because quite often what happens, I found this out the hard way last year with things like Teladoc, is company will come out with earnings. Those earnings could be fabulous, but if they're only in line with expectations, or even actually a little bit better than expectations, when the market is really not liking that sort of stock, you can easily find the stock will sell off very aggressively. So I'm going to try and incorporate that more into my business plan. So what I've written down there is when I think the market is turning more amber after a big run, start thinking about, or at least being open to the idea of buying puts on those high-flying, very expensive stocks that are due to mean revert or price valuation compress. And then in stage 3, really start to look for entries. Sorry, not stage 3, when the market's in a sort of red phase, or a sector's in a red phase, capitulation selling, amongst other things, looking for those opportunities to get in on these pullbacks, especially to key moving averages that traders looking for the 20-day moving average, and the 50-day moving average, and the 200-day moving average, and look for put buying opportunities there.